Hello everyone. Today I am taking our chapter called Capital and Revenue Transactions. So it's the capital and revenue transactions. So here the business transactions can be divided into two parts. Your transactions may be related to expenditure or the transactions may be related to receipts. Expenditure or receipts. Expenditure means it is outflow of money. Outflow of money. That means the payment. Expenditure means payment. Receipt means inflow of money. Inflow of money. That means the money coming into the business. Cash coming into the business. That is called receipts. Then expenditure can be further divided into capital expenditure or revenue expenditure. Okay, so expenditure can be capital expenditure or revenue expenditure. Now let's understand the difference between the two. Capital expenditure are those expenditure the benefit of which is for more than one accounting year. That means the capital expenditure provides benefit for more than one accounting year. So here the benefit from this expenditure is for more than one accounting year. That means here you will get long-term benefit. It does not occur again and again. That means it is one time, you can say. Then it brings in asset. That means this capital expenditure give rise to what? Assets. Right? So here, so the capital expenditure includes what? Purchase of assets. Purchase of asset. This is your capital expenditure. Then expenses incurred on new assets. Expenses incurred on new assets will also be considered as capital expenditure. Like you purchase a plant. Now this plant has to be installed in the business, right? And for that you incurred installation charges, right? So this installation charges incurred on this new asset, so that the asset will be ready for use, will be termed as or will be included as capital expenditure. The expenditure will be capitalized. Expenses incurred on assets to increase its efficiency or reduce the cost of operation. Cost of operations will be termed as capital expenditure. Another thing that you have to keep in your mind, expenses incurred on second-hand assets purchased will also be termed as capital expenditure. You have purchased the second-hand scooter, say. You have purchased the second-hand scooter and you have spent say rupees 5,000 on that scooter to make it ready for use. Then this 5,000 which is incurred on the second-hand scooter on repair work will be termed as capital expenditure. Right? So these are the different instances or the examples of capital expenditure. Understand this part. What is the revenue expenditure? The expenditure which provides benefit for one accounting period will be termed as a revenue expenditure. So it provides benefit or service for one accounting year. one accounting year. That means you get service or benefit from this expenditure only for one accounting year. The entire benefit is consumed or exhausted in that accounting year, right? These expenses are incurred for running day-to-day business. Running day-to-day business. That is called revenue expenditure. It occurs again and again, so it is recurring. It is recurring in nature. It occurs again and again, and the amount involved is small here. Amount involved is small here, right? That is called revenue expenditure. So what are the examples here? Purchase of inventory or raw material, payment of wages and other expenses, then money spent on maintaining assets. Money spent on maintaining assets will be termed as revenue expenditure, right? Supposing you want to whitewash your old building, so this whitewashing expenses will be termed as revenue expenditure because that is necessary in order to maintain the building, right? Those kind of expenses will be termed as revenue expenditure. Then now we come to the receipts, inflow of money, that is money coming into the business. Again, the receipts can be of two kinds. It can be capital receipt or it can be your revenue receipt. Now let's see, what is a capital receipt? It is inflow of money not from the regular operation of business. So it is inflow of money not from the regular operation of business. What is regular operation of business? Buying and selling of goods, the normal activity of the business. So any money that is coming not from the regular activity of the business will be termed as capital receipt. That means the money coming from other sources than sale of goods or sale of services will be termed as capital receipts, like raising of capital by issue of shares, debentures, by taking loans will be termed as capital receipt. Sale of fixed assets will be termed as capital receipt because selling of fixed asset is not the regular activity of the business, right? Again, it does not take place every time, so it is not recurring. So this kind of inflow of cash will be termed as capital receipts, and capital receipts normally gives rise to liability. Gives rise to what? Liability. That means you need to pay back whatever money you have received today, except from the sale of fixed assets, right? So if you have received money from the issue of debentures, that means what? You have received the money today, but after a certain period of time you need to pay back. At later date you need to pay back that money. That is called liability. Revenue receipt is inflow of cash or money from the normal activity of the business. Inflow of cash from the normal activity of the business will be termed as revenue receipt. that is inflow of cash from the sale of goods or sale of services, that is revenue receipt. It is recurring. It is recurring in nature. That means it keeps on happening. You keep on receiving the money, right? Now this need not be paid back. It need not be paid back. That means whatever you are receiving, you don't need to pay back. That is your revenue receipt. The examples, what are the examples here? Right? Selling of goods, right? Dividend received, rent received, interest received. All these are termed as revenue receipts. I hope you understood the differences between different kinds of expenditure and receipts. Now this expenditure, you have capital expenditure and then you have what? Revenue expenditure. Now it's very important to know the differences between the capital expenditure, revenue expenditure, capital receipts and revenue receipts. If an accountant doesn't know the meaning of all these different kinds of expenditures and receipts, then his accounting procedure that he has followed and the result derived out of that accounting practice will be wrong, because this revenue expenditure and revenue receipts affects your profit and loss, because this revenue expenditure and revenue receipts are shown in profit and loss account. This is shown in profit and loss account because this is used to calculate, or it is used to find out profit or loss. This revenue receipt is also shown in profit and loss account or statement of profit and loss, or you can say income statement. Capital expenditure is shown in the balance sheet, right, as an asset. Capital receipt is also shown in the balance sheet as a liability. As I told you, it is shown as a liability, right? So if the differences between the two is not known, then there will be a mistake with regard to the value of assets, with regard to the liability, and also affect the profit and loss of the business, right? So these are the different kinds of expenditure and receipts. Now, one more thing that you have to understand here is deferred revenue expenditure. Deferred revenue expenditure. Now, what is the meaning of this deferred revenue expenditure? It looks like a revenue expenditure, but it is not a revenue expenditure, right? Because number one thing is amount involved is large, amount involved is big. That means big amount is involved here. Normally in case of revenue expenditure, you have a small amount. Number one is this. Number two, benefit derived provides benefit for more than one accounting year. The deferred revenue expenditure gives benefit for more than one accounting year, right? But whereas revenue expenditure provides benefit for one accounting year. So it looks like a revenue expenditure, but it is not a revenue expenditure because of these two characteristics. That this kind of expenditures are normally termed as deferred revenue expenditure. Okay? Money spent is not on asset, but provides benefit for more than one accounting year. Then that will be termed as deferred revenue expenditure. What you have to say is, you have to see that the money is not spent on assets and at the same time you get benefit for more than one accounting year, then that will be termed as therefore revenue expenditure. The examples I give you: advertisement expenditure, on launching a new product is an example of therefore revenue expenditure, because the amount spent on this advertisement will be huge, and this amount is spent on the new product to advertise that new product, right? And the benefit that this advertisement will give is for long period of time, for more than one accounting period, right? That is why this will be termed as deferred revenue expenditure. But when you talk about only advertisement, it is definitely a revenue expenditure, because it occurs again and again. Now since this is on a new product, right, and the amount spent is huge, and the benefit that you derive from this advertisement will be for 2 years or 3 years, that is the reason why this expenditure will be considered as a deferred revenue expenditure. Okay, so these are the different kinds of capital and revenue transactions.